technically people aren't moving there in droves like the Northeast or the Northwest or the West Coast, right? It's just like homeownership is just not even really an option for most people, in those markets. So you just have such a larger segment of the population renting.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, welcome to another episode of the Alternative Investor Mastermind. I've got a great guest today, Axel Ragnarsson, who I know through a mastermind group. And Axel, thanks for coming on the show.
Absolutely, thanks for having me.
So just by starting off, why don't you just tell us a little bit about yourself and your journey into investing?
For sure. So I live in Boston, grew up in New Hampshire, so I've always been in the Northeast. Parents were business owners. They ran a wood chipping business of all businesses, so nothing to do with real estate, but was exposed to entrepreneurship at a young age, and had the opportunity to kind of flex that muscle. And I think I got that entrepreneur DNA a little bit. Never really had a job, always buying and selling stuff to make a couple bucks. And that led to late high school, early college. I was buying and selling cars. That was kind of like my income source, was doing that. And as I was getting closer to graduating college, I was like, all right, what comes next? Didn't really want to get a job. I knew I wanted to work for myself in some capacity, and basically at that point, learned about real estate. And I think I just accidentally stumbled upon it through HGTV, and maybe found a podcast or an Instagram post or something, and started learning about flipping houses, and that was going to be what I did after I graduated, was start flipping houses. So I got my license, started learning all about it, and realized that wasn't necessarily for me. Very risky, very time intensive. You do the work once, you get paid, but you don't, it doesn't pay you in perpetuity. And along this road, I started learning about multifamily real estate, rental real estate, passive income, and just the idea of building a portfolio that pays you every month, right? And that became really intriguing to me. So I started buying small multifamily properties, 3 to 10 unit multifamily properties throughout New Hampshire back in 2016-17 after I graduated college. Did that for a few years, built a portfolio that basically paid the rent, and kind of there was some money there, but I basically hit a wall where I was like, is this really is this the roadmap ahead for me? Because I don't want to just keep buying small multifamily properties throughout New Hampshire. That feels like there's a cap on what I can do if I keep doing that. So at the time I was living in Boston, and I was kind of like, New Hampshire's technically out of state for me. It's an hour drive. Maybe I just go a little farther out of state, start looking at other markets, start looking for bigger deals, and started to expand what I was doing. At that time, we started getting a little bit more serious about raising money. Everything I had done up to that point was, with my own money, outside of working with private money lenders and doing some creative finance stuff, but it was all my capital from an equity standpoint. So, started trying to build out, the base of investors while I was looking for larger deals, trying to buy more deals. And right around 2020, late 2020, early 2021, we started doing some deals out of state, and we started doing deals in Central Florida. That was kind of the out of state market we selected. And then we started doing some slightly bigger deals up in New Hampshire. So, we went from doing 20, 30 units just with my own resources to couple hundred units a year, raising some money, doing some very simple, small joint ventures, small syndications where we'd raise, $1.5 million, couple million, $2.5 million bucks, like nothing massive. And that really brings us to where we're at today. I mean, the last couple of years we've done 300-400 units, and we built out a property management company in New Hampshire. So we're really operationally, well built out in New Hampshire, and it's great. We're looking to continue growing. We're getting a little bit more serious about raising money, getting more serious about building out the capital side of the business. I've historically been a deals and operations guy, so now spending more time raising money and looking to continue growing the business from here on out.
That's a great story, and I think someone who got started at 21, 22 myself, it's really awesome when you find it so quickly. So you've never had a corporate job in your life, then? Right.
So I moved to Boston. You know, I had like 10 units, like a few buildings, and I moved to Boston to take a job. And my third day at the job, it was a business development, role, just a kind of an entry-level job in Boston. Third day on the job, I got a call from a seller who I had sent a direct mail piece to, and I couldn't answer it because obviously I was at work, and it was, he called me at like 11. By the time I got home, and it was a pretty demanding role, so I got home at like 7:30, and I'm looking at this voicemail. I give the guy a call back, and he says, call the guy after you and tied it up, put it under contract. And it would have been a screaming deal, would have made the same amount of money in that deal as I would have a year just working the job. And I was like, well, this is stupid. Like, this makes no sense. Why am I here? So I went in the next day, Thursday morning of my first week, and told my boss, just told him the story. And I was like, I just can't, And he was obviously like a little PO'd, but he was like, I get it. The logic checks out. So that was my corporate experience. Long story short, was a few days. Yeah.
Wow, that's so. You mentioned. I want to ask really quick about the flipping of cars, because I think some of the marketing principles are probably might be similar. Like, and I know for me, a big aha moment was just committing to sending out direct mail myself. How did you pick that up, and how did that translate into kind of just jumping in and being successful and making the phone ring on the real estate side for distressed sellers?
Yeah, I mean, it's funny because I look back and I'm like, it's literally the same thing, just the numbers are different, and the quote unquote investment. Cars aren't an investment, right? But the product investment was a little different. And my process for finding deals when I was doing that with the cars was, I would have two windows up on my computer, or one on my monitor, one on my laptop. One was just Craigslist, the other was Kelley Blue Book, and I would just go through Craigslist into all the used cars, and I kind of identified, like, I like, sedans that are between $4,000 and $7,000. I would filter it out, and I would just go into every single one, put the information into Kelley Blue Book, see what the Blue Book price is, see what the guy was asking, and then I would make an offer at some figure that was below what he was asking, and we would buy some cars, right? Somebody at some point just wanted to sell their car, and I'd go buy it, and then I'd throw it up for the full Kelley Blue Book value, right? And sell, buy it for $4, sell it for $6. And that was what I did. And then when I started on the real estate side, I just went right back to Craigslist. This is 2017. Or 2016, I should say, and I just pulled up for rent for sale by owners, and then also for rent ads. Started emailing every owner who listed their property for rent and said, hey, I don't want to rent, but I'd love to make you an offer if you want to sell. And then I would just email everybody that listed their property for sale, right? All the for sale by owners. Just did that until I got a deal, and bought a great deal. Did that again. That's how I bought the second deal, and since then it's obviously evolved. And I was like, all right, this direct-to-seller thing is how we find deals. And that's the whole thing when you're getting started out. You got to find smoking deals if you want to make your dollars stretch. So for me, I was just obsessed with finding great deals. So I started, emailing owners directly, and then I started sending direct mail, started doing some cold calling. And that was really how, like, over the course of our business, we bought over 500 units in the last, most of being in the last 4 or 5 years, really the most being the last 3 years. Basically all been direct-to-seller. We did one 28-unit deal in Florida that was brokered, but pretty much everything we've done is go direct to seller, because that's where all the inefficiency is, right? We want to be a little farther upstream. We want to get to the owner before they engage with all the other buyers and the broker and all that. And we still try to get deals done with brokers, et cetera, but that was really kind of the playbook for me, at least. And this is how we grow this business more quickly, is doing something that everyone else isn't doing, and everybody else is just waiting on properties to hit the market, or they're just waiting for their broker to send them an email. And I'm like, that gets you mediocre results. I want to get better results, so I got to go do something different. And that was kind of the playbook for me.
That's great. It just reminded me of a real quick story. My buddy Dino. This is before both of our times for the most part, but during the early days of eBay, he would put an ad in the New York Post for used computer equipment. And it was probably like kind of the early stage of the .com, like 99, 2000. And he would buy computer equipment off of ads in the New York Post, and then put it on eBay or Yahoo auctions, and sometimes double his money. That was a different level of arbitrage, because you had kind of the 50-year-old people who weren't even on the internet yet, and then you had the other people that were on the eBay auction. So it was a crazy inefficient market. It makes me wonder, just with some of the AI and some of the more advances here, if there's going to be some other arbitrages. I mean, real estate's getting more efficient, but it's still way less efficient market than most others at this point.
Yeah, and I'll touch on that, because that is kind of the basis of everything we do. Is we go to markets that are inefficient, and that's where we can optimize what we do, where we can operate better, where we can buy deals at better prices, where we can finance more effectively than everyone that's local. And just I'll add to that story, and not like everybody who's listening to this podcast is trying to figure out how to flip Xboxes. That's what I was doing for a while in high school, and also in college while I was doing the cars. Is go on Craigslist, you get some guy who's selling his Xbox and 30 of his games. I'd go out, buy the whole package for a few $100, and then I would list each game individually on eBay and sell those individually for, $10, $15 each. And some guy who didn't want to do that, he's just selling the package, right? And then, buy it for $3, sell them piecemeal for $600, $700. I mean, that's just what we're doing, right? We're just doing that at a larger scale in real estate, And we love portfolio deals for the same reason. We love buying 5, 6 small buildings in one transaction and then selling them individually. And you maximize your price per unit, right? So it's funny how you can tie back the fundamentals to just smaller stuff.
Yeah, and that works both ways too. I know a couple operators that have 2 or 3 buildings in a market where if you could amass a few hundred units, some cases you could actually sell institutionally as well.
Yeah,
exactly. If you're at a point in the cycle where the institutions are looking to grow and aggregate units. So it's a crazy market. I get a lot of people, until you've done a private placement and until you've raised money, it's like a very intimidating and daunting thing. And I get so many questions of, how do you structure a fund and just how was that journey for you from just going, from hard money lenders or maybe 1 or 2 friends and family where maybe you just did an LLC to doing a more formal offering?
Yeah, it was extremely intimidating for me. I mean, it took me years to get over just like the fear of raising money. I always loved the idea that like I never had a boss, and you could probably tell in this conversation, like I'm so hypersensitive about not having somebody looking over me, right? So I didn't want to raise capital for that reason, and then I also was just fearful from what if it doesn't work out, right? And I was constantly afraid of that, even though I had a 20, 30 deal track record of doing the same types of deals successfully, right? But for me, I was always so paranoid about that. And then I remember I had a conversation with a guy who was a private money lender, and he was like, "You're telling me that I could make double the rates that I'm lending you money at if I just invested alongside you?" And I was like, "Yeah, probably easily, like 100%." He's like, "Well, I just want to do that then. Like, I just want to do that. That makes way more sense for me." And it was like his confidence in like, I've lent you money on 10, 15 of these deals that have all gone extremely well. He's like, "Can I just partner with you and you could do bigger deals?" And that was really how I started the raising money journey. In terms of like the tactical, putting the documents together, the legal side, all of that, that was also very intimidating. I remember at that time I just called up a handful of attorneys. I didn't want to just get one attorney's opinion, because I think depending on who you speak with on the attorney side, like they'll just tell you literally cannot do a single thing, and they're just in the business of literally saying no, you can't, nothing works to some attorneys, right? So I spoke with a few. I kind of got some diversity in opinion, and I found some moderate attorneys that really wanted to protect everybody's but legally, but understood that there's some nuance to those discussions. And then I just asked, I just proposed a situation like, hey, I want to go do this deal. I want to go bring this person in. This is how we're thinking about structuring the equity. Like, how do we paper this in such a way that makes sense? And it was just kind of continuing to pull that thread. So the first few deals we did were like simple JVs with a few partners, 1 to 3 investors in an LLC, right? Everybody kind of had a job, so we weren't crossing the syndication threshold where these investors were investing in a security because they had no control. Some voting rights, and we papered it in such a way that was compliant. On the syndication side, first syndication I did, and I was very intentional about this, I wanted to just be a partner in somebody else's syndication. So I brought in a couple of investors, and I invested myself. I think we put together like $200,000. I just found a close contact who had experience syndicating deals. And I said, "Hey, I know you would never do this. Like, I'd love it if you did me a favor. I don't even want any of the general partnership. I'll help you raise some of the money here. I'm not asking for a co-GP. I just want to ride shotgun through this process." So, you BCC'd me on the emails with the attorneys. I got to, read a PPM. I got to see some of the questions he asked back and forth. Got to ask him questions. And just seeing it, right, was really helpful. Because then I nailed down the language and what all the language in the PPM means. The process. How long does it take to put together a PPM? What other documents do you need outside of the PPM? How can you structure a PPM in such a way that makes sense for your given deal? And that was extremely helpful. And then after that, I was like, all right, I'm going to go do this myself and still probably learn a couple things. I'm going to do it on a deal that really makes sense, where like, yeah, maybe, I give up a little bit more of the deal or something like that to entice investors, but it allows me to learn this process, to spend a little bit more money with the attorneys, pay them a little bit more hourly, to really make sure I understand everything. And the first deal we syndicated was a deal down in Florida, and I just asked so many friggin' questions. Like I was like, I'm paying for education right now, and I was very conscious about that just during a live deal. And that's how I went about it, right? Because I think it is extremely intimidating. I think it's just easier if you just do it with somebody else that's done it before, and then you're just doing it with someone that can answer all those questions. That's what I tell people now that we've done a handful of them. I'm like, hey, if you're worried about doing a syndication, you got a deal that requires that, bring me in. We'll partner on it. We'll co-GP it. I'll give you the bulk of the deal if all you're looking for is somebody to help you walk through that process and maybe to help operate or raise some of the money. That way you don't make any big legal mistakes, or you don't stick your foot in your mouth, or you don't structure it incorrectly, or something along those lines. So that's what worked for me.
Yeah, that's incredible information, and I know so many people want to get into real estate and either they think small and they try to buy themselves a single family or do an Airbnb and they essentially create themselves a job. But to break into the syndication market, it's really you don't just go right to one. To go from 0 to 1, you generally need to partner on a deal, and it was very smart of you to ride shotgun on a deal. That's the perfect analogy. And in many cases, you can't just do it all yourself. You need to be, Fannie Mae requires key principals. You need someone who has experience, has signed on a loan before. So, I mean, maybe if you're a billionaire, I don't know, maybe there's a point where I don't know if there's exceptions, but in general, there's net worth requirements, there's liquidity requirements, there's experience requirements, and you really do. It is a team sport, and you really do need to partner with and find a good group of team members to really execute in this business at scale.
Yeah, 100%. And I think that the stakes are too high when you're raising other people's money to not do it, because the easiest way to just fall down before you even get rolling is you do that first deal wrong, right? And there's any number of things that can go wrong. You could just buy a bad deal, which has nothing to do with the legal structure of a syndication, right? Which obviously you don't want to do, but it's helpful to not be fumbling around as investors, or like, hey, what does this part of the operating agreement mean? And you never have the answers to the questions. Like, for me, I was very conscious to try to avoid that. I wanted to be able to speak eloquently about the nuts and bolts of the agreements, of the legal agreements. And I think that just solicited a lot of confidence, right, in the folks that I was trying to raise money from. And if you don't have a track record, you're going to be vetted that much more thoroughly by anyone who looks to invest in you outside of like your mom, dad, sister, brother, college buddy, so like you have to be able to speak the language a little bit, and obviously you just need to know it yourself so that you understand it, right? Because I've seen a lot of syndicators that didn't even understand the language in their own documents. Like they didn't even get what they were like, what the actual structure of the deal was, and there was misalignment between what they thought the deal structure was and the deal structure that was disclosed in the PPM and some of the other mechanics, and it's just like, what a jumbled mess that is for everybody, right? So I think it's really helpful to just learn from somebody else.
Yeah, that's a really interesting point, and I'd say some of the positives of the last number of years is there is a lot of software available now, and there are more boilerplate type of private placements where it shouldn't cost you $30,000 to do a private placement this day and age, but at the same time, the barrier to entry is a bit lower, and it sounds like that particular sponsor kind of probably took an off-the-shelf agreement and didn't really fully understand the intricacies, or didn't catch all the customizations, and their offering memo didn't really match the PPM, which is to me would be a major red flag, and it sounds like it was to you as well.
Yeah, I mean, I've seen some folks, and again, I don't want to disparage anyone. It's all a learning process, right? You just want to learn before you're learning live in a deal, right? Where like, they had an idea of what the waterfall was in their head and what they put in their pitch deck, but the language in the PPM or the operating agreement included slightly different language as it related to how the waterfall returns were calculated, whether it was a preferred return accruing if there was a shortfall or not accruing, or if you have a preferred equity of some kind, then it's like, well, the pref equity is getting paid their preferred return before the other share, the other class shares. But when we sell, everybody just gets their money back evenly, and the pref wasn't treated preferentially, and there was a misalignment there. And it's like, so there's like, that's specific to one part of the agreement. But it's just like the same thing as reading your loan documents, right? I think a lot of people just don't read their loan documents that actively do deals, right? A lot of the newer investors, they just skim them, right? They skim them and they miss that section at the end that says the lender was guaranteed some minimum amount of interest, or that they didn't, they thought that the floating rate after the first few years of fixed rate was based on a different metric, or whatever it might be, right? And then they get surprised. I mean, I've been in deals where that's happened, where I've passively invested in deals where a sponsor didn't read the loan documents, and next thing we know, we're getting whacked with a prepay that was like fine print, 10th page of the loan docs. So it's the same thing from a PPM standpoint. You want to know that stuff back and forth, and it's like, it's great that there's a lot of capital coming into this space, and it's great for the everyday investor and for this industry at large, because the more money we get out of, Wall Street and into private investments, in my opinion, the better. But it's the challenging piece is you have to be really diligent as somebody who's raising money, and then if you're a passive investor, right, maybe you're not going to go read this deal's loan docs. That's probably not the best use of your time. That's why you're investing passively. You don't want to do that. But you need to make sure you're investing with a sponsor that does, and ask some of those questions and do some diligence at that level.
Yeah, absolutely great points here. I want to talk a little bit about interest rates. I'm a couple of years older than you, but really this is the first major interest rate raising cycle I've been through in 20 years. How have you navigated, from COVID the record low rates to record high rates in a period of 3 years?
Yeah, it's funny. We I guess we were. I think the math dictates, or dictated for a very long period of time before late 22 or mid 22 when rates started to go up, that like floating rates was the most economical way to finance value add multifamily deals, because you're not constrained by a hefty prepay. And when you're done with your value add, you can do something, right? And there's math that backs this up over the last 50, 60 years. Obviously, the last couple of years, not been the case, right? Or the last year and a half or so. We were too inexperienced to know that, hey, you should float your rate if you're doing value-add multifamily. So we were constantly just fixing our rates. So we backed into a situation where we had no distress at that level. And from a fundamental approach in our business in terms of how we do deals, we do deals in slightly higher cap rate markets, right? If we're going to define low cap rate markets as Tampa, Dallas, Phoenix, Orlando, Jacksonville, Austin, Texas, all of the Southwest, Southeast, Texas cities that all of the data, people are going to these cities in droves, et cetera. They were 3.5 cap to 5 cap markets, depending on the class of asset for, a few years there. And we just never did deals in those markets because I always looked at the math and said, what if cap rates go up 1%? Cap rates going from 4 to 5% has an astronomical effect on values. A significantly more outsized effect on values than cap rates going from 7 to 8. That's less of a percentage increase than going from 3 to 4. So the markets that we invest in, Central Florida, which is, through 2020 to 2022 is historically was, a 5 to kind of 6.25 cap rate market, depending on exactly where you were. Now that's a higher cap rate market, 5.5 to 7, it's creeping up a little bit more. But cap rate expansion, when you're investing in a market that's a little bit of a higher cap rate market, it has less of an effect on your values, right? Your asset value. Same thing with New Hampshire. New Hampshire being 7 to 9, depending on where we're investing. Got down to 6, but most of the smart local guys weren't buying stuff at 6. They were buying stuff at 7, 7.25, 7.5. So all that to say that we invested in slightly higher cap rate markets. So as interest rates go up and cap rates start to expand as a result, we're still maintaining positive leverage. We're still not seeing like value destruction that's equivalent to what we're seeing throughout Texas and Florida. I mean, Florida and Texas are tricky right now because of the insurance component as well, which has had more of an effect than I think rising interest rates has had. Like, insurance rates going from $600-700 a unit to $2,000 a unit has had just as much of an effect as rates doubling. So, in terms of how we've dealt with it, we've just really, every deal we underwrite, we're so obsessed about our yield on cost being higher than 1, the market cap rate, and 2, just our prevailing interest rate on our debt, right? So it's, if we're doing deals in New Hampshire, we want to see after we're done all of our value add, an 8.5-9% yield on cost. And then when you compare that to a 7.5 cap in terms of what the property would be valued at, not only do you have value creation, but you have positive leverage along the way. And, if something goes wrong, you can continue to hold and operate, pay your debt, and still have some money left over. So it seems really simple, and I guess it really is. Like, that's kind of fundamentally how we look at the business right now. And if cap rates go from 7.5 to 8.5 or 9, well, that was our yield on cost, and now we're at a break-even point, right? So we're giving ourselves plenty of space there to quote unquote let the market kind of tank on us, right? So that's how we view doing deals right now. And then we're also investing extremely heavily in operations. So we own our management company in New Hampshire. So we have our staff in-house. Like I have staff in like the investment business and kind of the parent company, Aligned Real Estate Partners. I have a director of operations whose sole job is to just manage, asset manage and operate our properties. So like on a day-to-day, week-to-week basis, we are maniacal about managing our vacancy rates, our maintenance response times, our renewal rates, our, just managing the expense side of the P&L, making sure that everything is copacetic there, managing our CapEx budget, making sure that we're spending less than what we budgeted. And if we're spending more, there's got to be a really good reason for it. And there has to be some commensurate growth in rents or reduction in expenses that allows for that. Which is different than what I think a lot of people have done the last 4 or 5 years, where you could just buy a deal and the market would take care of it for you, right? Because it's like rents were just kept running and running and running, and it was operations where it was important, and you get on a call every couple of weeks with your management company to make sure the place hasn't burned down. But now there's a requirement to be a little bit more diligent, because deals are harder to come by, and if you're going to buy a deal, you have to operate your butt off to make sure that you're staying ahead of what the market's doing, and to make sure that you're staying ahead of what everybody else is doing in the market. So those are really the changes for us. That's kind of how we've started to look at the business differently. Last thing I'll mention, because of being long-winded, is on the debt side, we're fixing all of our rates. Like, I know some people that are still floating because they're like, well, even if rates go up another 50, 60, 70 basis points, like it still makes some more sense to float because we're kind of at the top, and then we can float our way down if rates start to come down. I guess there's an argument to that. We just don't even want to deal with the stress of it. We don't even want to deal with the stress of buying a rate cap. We don't even want to deal with any of that. And we've started working with a lot of local banks and credit unions where we can negotiate 5-year fixed rate terms, maybe to adjust for another 5, and then we have a 10-year term. But we can negotiate, maybe a slightly higher rate. We'll go from 6 to 6.15, 6.2, and then we'll like wipe out a prepay. So we're having our cake and eating it too, where we have a fixed rate, even if it's a little, slightly higher than what we would have paid if we, included prepayment penalties, but we're negotiating away from prepayment penalties, so we still have that flexibility along with a fixed rate. So that's kind of what we're doing on the debt side. But I'll stop there because I'm probably talking your ear off here.
Yeah, that's great. That's great information. We're primarily in the Southeast and the Sun Belt, the more competitive markets that you mentioned. Haven't really looked much in New Hampshire. And what has the rent growth been like? Have you gotten sort of the COVID/digital nomad bump from people that would have lived in downtown Boston but are now moving an hour or two away into New Hampshire?
Yeah, so New Hampshire is the only state in the Northeast with positive population growth, and that includes like all of New England. So it's like Maine, Vermont, Massachusetts, New Hampshire, Rhode Island, Connecticut, New York, New Jersey, Pennsylvania. All of the Northeast U.S., New Hampshire is the only state with positive population growth. Very business friendly, no sales tax, no income tax. It's low cost of living, very tax friendly state. So businesses are moving there, people are moving there, and we saw absurd rent growth, similar to the rest of the country, right? I mean, everybody kind of experienced this, but the on the ground dynamic with New Hampshire and really the Northeast in general as a region is it's extraordinarily challenging to build. It's a very, very supply constrained market, which is contrary to what's happening in a lot of Phoenix or Houston, right, where there's land to build. It's easy to build from a government red tape standpoint. Rents support ground up development, and there's just more supply being added. In New Hampshire, right, it's rents are a little bit lower than those markets, so it's not as profitable to build because building costs don't make sense as it relates to the rents you achieve. So build to rent doesn't really make a lot of sense. There's just less land, and it's geographically more challenging to build. You got the ocean, you got mountains. It's not just flat land, right? There's less area to build, and there's just less national interest. So there's less national investors going, all right, I'm going to go build over there, right? Whereas everybody was trying to keep pace with population growth down in the Southeast from a building standpoint. So a lot of people, we had a good chunk of people moving there with no supply being added, with all of the inflation components to what's happened over the last few years, and rents started to go up like crazy. The city that we primarily invest in, Manchester, New Hampshire, which is exactly an hour north of Boston, rents went up. I think it was like 17, 18% in 21. Went up another 10% in 22. Like there's still really serious rent growth there. It also, New Hampshire has one of the highest occupancy rates in the country. Vacancy is 0.3, 0.4% statewide. It's like 99.5% occupied at any given time. It's incredibly high levels of occupancy throughout New Hampshire. So it's a bit of a unique market in that there's all of these little, there's little arguments for doing it, but it's just a small state, and it's hard for anyone to reach scale there, right? So the guys that want to go buy a 100+ unit asset, and they're not interested in buying, a 15 unit, a 30 unit, a 20 unit, and kind of doing this piecemeal over the course of a couple of years to get to some critical mass. They just don't even bother because there's only like a handful of 3-4 deals that trade of that size in a given year. It's not a very active market in that respect. But for the people that are willing to do kind of the mid-sized deals, which is our business, we see a lot of success up there, and that's that's the argument for New Hampshire and the Northeast in general right now is just supply constrained, right? We're seeing the markets that aren't supply constrained experience a little bit more of a boom and bust dynamic. Like Phoenix, for example, year-to-date rent growth in 23, it's down 4.5%. Rents have declined 4.5%. Rents in New Hampshire are still up, basically the inverse of that, 5-6%. And the same thing with Massachusetts, same thing with Maine, Vermont, a lot of these Northeast towns where it's just hard to build. So bit of a different type of market. I think it's a nice compliment for a lot of people that do deals in more, boom bust type environments where there's a lot of capital that runs in when the market's great, and then a lot of capital pulls back because they get a little bit nervous about how much is being built, and they get a little nervous about some of that dynamics, and the cap rates are lower, so there's more cap rate going from 3.5 to 4.5 has a real significant impact on values. So that's really the dynamic up there. I mean, that's our argument for it, at least.
Yeah, that's great stuff. I'll just add on the rent growth statistics. It's also just what subset of the market you're in. If you're in the Class B, I imagine we're both in value add. So in some cases, the statistics may show a rent growth or a rent decline, but the value add Class B may be up regardless. You could have the Class A down 10% and Class B up 3% just because there's a shortage of that product. You can't really build Class B profitably unless there's some crazy tax incentives or a public-private partnership. So it's just very important to kind of know the sub-market for sure, as I'm sure you guys do.
100%. Yeah. I mean, I don't think Class C. We do about half Class C, half Class B. I don't think that there's any Class C, markets or that subset of the multifamily market anywhere in the country where rents are going down, because that's the most in-demand housing that we have right now, and there's it's not being built, right, as you just mentioned. So that's a good point, right? And Phoenix, Phoenix is a good example. Phoenix is a great market. I don't mean to pick on it at all here. I would be happy to invest in Phoenix. I think this is temporary, right? Just a lot of supply at this specific moment in time, but people will keep moving there, and they'll occupy those units. But all of the new development, all of that supply caters to the top end of the market, right, where rents are a little bit more sensitive. They're a little bit more sensitive to what's going on from a macroeconomic standpoint, and on a percentage basis, they're a little bit more sensitive. So you're right. I mean, doing that additional level of diligence on a market, I think, is important.
Yeah, I remain bullish overall. Just, I think the average baby boomer now is 65. So in addition to just the standard population growth, you've got baby boomers moving with houses that might be paid off that, are going to, some cases they'll buy, some cases they'll rent. If they buy, there's already a limited supply of the single family market as well. So, it seems to me that we're going to have like potentially a generation of renters, or at least an extra, maybe you have to wait 10 extra years to really buy, just given where rates are right now. It's really priced a lot of people out.
Yeah, it's honestly too bad. Like it's tough because like I have a lot of friends, right, that are they well paid W-2, right, in sales, or they're an engineer or whatever, right? They work in the city of Boston, they make 6 figures plus, they do well, and they're not even remotely close to buying a house. Like they're so far from being able to do that, it's wild, right? Because it's like and I think the big thing too is student loan debt. Student loan debt has just wiped out the ability to buy a house until you're in your late 20s. For most people that went to a 4-year college and spent between $25,000 and $50,000 a year on that college, which maybe is expensive for different parts. I mean, 25 is any state school nowadays, right? So you come out with $100,000 in student loan debt. You are trying to pay that back. Rents have run everywhere in the country. Rents are so much higher, outpaced earnings growth. Home prices are just through the moon now. I mean, home prices still haven't really rebounded as a result of rates increasing, right? Now, the single-family home market is still extremely active. At least in the Northeast too. Like housing hasn't come down. Prices haven't come down for single-family homes at all. Like because there's just no supply. So it's it's just like this violent cocktail of events that is making it extremely hard for anybody to buy a house. And anyone, these folks I know that make 150, 200 grand a year that are personal friends of mine that I went to school with, like maybe they can buy a $500,000, $600,000 house at today's rates. That doesn't get you a lot in the Northeast. Within 30, 40 minutes of Boston, that's a 3-bed, 2-bath ranch, right? Which high cost of living here, of course, but there's just, why would you do that when you can keep renting at a significantly lower price than what you'd buy at? And the other thing too is people want flexibility as well, right? They don't want to be tied to a location until they're 30 or, and this is again relative to my area. This is different in the Midwest. People buying homes earlier in the Midwest, I think, just culturally speaking. But yeah, it's unlikely that the home ownership rate continues to increase over the next 5 to 10 years. It's just going to continue to tank, right? I think, as you mentioned.
Yeah, absolutely. There's a lot of people that are stuck. I mean, I'm in that situation. I luckily bought a condo in Puerto Rico in late 2020, and 2.8%. I'm never going to sell this thing.
No, you'll rent that out, right, before you ever sell it.
Yeah. But even if I rented it out, I could make a profit on it. But then I'm going to have to overpay on a mortgage for something. So I'd think of trading up if rates were still low. But right now, it's just not worth it. And someone quoted me a statistic that about 40% of the population actually doesn't have a mortgage. And I think you lose sight of how many just people have the house paid off, and their goal was to be debt free, and then another 30% are locked below 4%. So that's going to continue to constrain supply for years to come. And there's a lot of people in that spot that maybe would have traded up, but they're just going to sit tight, and really it's going to have to rely on life events. Medical or major job change. That's really the only supply that's coming to market in many markets is going to be those situations. So I think we're going to be seeing this for at least a number of years.
Yeah, I completely agree. I think the challenge is that there's just, as you mentioned, there's no financial distress. Like there just isn't really, by and large. I mean, at least in the single family world, like if you bought your house 2017, 18, 19, 2020, or even in early 2021, you just immediately gained 20 to 50% in equity on your house. So there's just a lot of folks who have a $700,000 house that bought it for $350 and their mortgage was $300 or whatever it was when they bought it, and now they have 60% equity, and it's like, what's the incentive for those people to move? I mean, there's just no incentive, right? So it's basically like you have a rent controlled apartment, right? And you're not going to move because you don't want to give up that rent control. It's basically the same thing. It's like you got rate control. So yeah, I think it's an interesting dynamic, and specific to higher cost of living areas, I think it's going to become more and more prevalent. I think that's a more prevalent dynamic in all of these markets that have experienced insane home appreciation and where the median home price has started to really outrun the median income in that area. Like, maybe less of a dynamic in Tulsa, Oklahoma than it is in Phoenix or Tampa or around the Boston area or around Boise, Idaho, or any of these markets where just home prices have exploded. So I think that's an argument for investing in some of these markets that people traditionally haven't invested in, because technically people aren't moving there in droves like the Northeast or the Northwest or the West Coast, right? It's just like home ownership is just not even really an option for most people, in those markets. So you just have such a larger segment of the population renting.
Exactly. So you do a great job of putting out content. You've got a pretty large Instagram following. Let's talk a bit to those investors that are trying to learn more. You mentioned you have some sales professionals and some high W2 earners. The goal of this podcast is to expose people more to alternative investments, and we have a tagline: "Get off the stock market roller coaster." Let's talk a bit to that audience of people that are maybe only in stocks and bonds, but they're accredited investors and they're looking to do something different. What advice do you have for those that are looking to get started? Maybe don't want to be a GP like you became, but want to have some exposure.
Yeah, so I'll try and boil down a lot of thoughts on this topic into kind of a few bullet points. I think the first thing is important that you just mentioned in an accredited investor who wants to get off the stock market roller coaster. We primarily do 506Cs, and we're thinking about making a change in our business to just only doing 506Cs in the future, because I think the biggest hurdle for a lot of folks in investing passively is the lack of liquidity, and that's an easier pill to swallow if you're an accredited investor who's got a couple bucks. So I think that's really important, is become comfortable with the lack of liquidity in investing in these types of opportunities. Second thing is, I believe that it's really beneficial to invest directly with a sponsor that has sector-specific focus, and then even better in a certain geographical area. And if you're not investing directly with them, maybe you're investing through a fund-of-funds manager or somebody else. But ultimately, the operator of the asset, in my opinion, I think it makes a lot of sense for that person to be like the multifamily guy in Georgia, right? Like they got their team in place, they're local to the market, they have deep, extensive local relationships versus the guy who buys some multifamily in Georgia but also buys some self-storage in Florida, and he's got an industrial deal as well. I think it's really, really helpful to focus on sector-specific operators. I think that's a huge thing. Number two is, I think you just start small and start to develop a familiarity with how people operate. I highly recommend sponsors invest like the absolute minimum, if not asking for the minimum to be waived. Maybe if the minimum is $50K, you try to invest 25 or something like that with an operator, to get a sense of how they communicate, to get a sense of how they work through that process. And just investing with one person doesn't give you the perspective to see who you like to work with. So in my opinion, if you got $100,000 that you're thinking of investing, my 2 cents is, get 50 with a couple of folks, maybe get 50 with one, 25 with 2 others. And now you got 3 sponsors who you're communicating with, who are giving you reporting, starting to get a sense of how they operate, how they approach deal making, et cetera, how they approach investor communications. And then you're like, oh, I really like working with this person, or I really like how that person communicates, and I want to do more of that with that person, or find other sponsors that communicate that way as well. So that's the other thing that I would suggest. And then 4, I guess, it's I think that the Wall Street financial advisor would give you the portfolio allocation tip of like, you don't want to put more than 5% of your investable assets into private investments, whether that's crypto or real estate. They lump all of these private investments into one thing, but each of these types of investments has a different risk profile. Investing in options or crypto probably has a slightly different risk profile than investing in real estate. Investing in development, within the real estate sector has a different risk profile than buying stabilized multifamily. Those are 2 different types of deals, right? So I think you should get comfortable with the risk profile of investment that you would like to invest in, depending on how much money you have, which stage of life you're in, what your goals are. Do you care about cash flow? Do you care about equity growth, et cetera? Do you want some distributions now, or do you not really care and you're just really looking for a nice pop at the end? And then assign 10, 15%, whatever it is of your overall investable assets to each of these subcategories, right? That would be, kind of the portfolio allocator tip, I guess, from a high level. But that's my tip to folks who are totally new to this, right? And they're not even at the point yet where they're trying to vet multifamily deals. They're just trying to conceptualize participating in the business from a passive investor capacity. So that's what I would do. And then after that, train yourself a little bit on how to identify great deals within the type of investing that you want to do. If it's self-storage, go link up with a few self-storage guys, read all their lead magnets, listen to a couple of self-storage podcasts, kind of learn the fundamentals, learn what you should be asking, how to vet a deal at a high level, how to vet a market at a high level, how to vet a sponsor, most importantly, just at a high level, so that you get, you can do some level of diligence outside of just sending money, right? But I guess that's step 2 after you do some of the other things I mentioned.
Yeah, that's a great point. And I've when I talk about passive investing, I'll often make the argument it's active passive investing, the reading, the research, the potentially going to a conference. There's a number of large conferences where 1,000 people show up, and there's a combination of sponsors, speakers, operators, but more importantly, other investors that have already made the jump and are actively investing, higher, like large percentages of their overall portfolio into private funds and syndications. So I think that 1 to 10 million net worth is really underserved, where a great majority of them still have a majority of their money in kind of just stocks and index funds. And once you get into that family office level, the higher net worth, often 50% or more of their money is in private equity, real estate, other non-retail stock market.
Yeah, and you can't rely on the the financial advisor at Fidelity or Charles Schwab, or I feel like I'm picking on those 2, but the first 2 that come to mind that are like, yeah, we'll get you 30% bonds, 50% stocks, 10% something else. 10% is the fun stuff. We'll get you in some crypto or in a couple of REITs. I love that. I love a financial advisor that defines a REITs as an alternative investment when they're building out a portfolio allocation. It's just not. It's a stock. But for me, that's what I think is, if you're speaking with those folks, they're always going to shy you away from doing anything that they are not incentivized to sell you. And it's just the hard truth, right? That's the fundamental hard truth. They're not getting paid if they send you over to a real estate buddy they know who's syndicating deals, unless they get some back-end arrangement, which I guess could be possible. But the vast majority of the time, they're not incentivized to help you get into these, asset classes or investment opportunities that provide the outsized returns. And, I don't think that you should be allocating a large percentage of your net worth, of your investable assets, into private real estate or any other private, alternative investment, unless you've done it, you've allocated your smaller portion, you feel really comfortable about how to vet deals, vet operators, and you're comfortable with the risk profile of getting into getting into more of those types of deals. I think that a lot of people learn about this and they get really overzealous, and they're like, 17% IRRs, you can double my money, in 5 years. We got distributions along the way. It's tax advantaged. I love it. I want to jump into this. And for me, it's like, all right, well, hold your horses, right? There are some negatives, right? There's lack of liquidity. You don't dictate when we sell, right? There's oftentimes going to be, oftentimes, I guess right now, if you're investing across multiple different sponsors, especially if you're in the Southeast, Southwest, where things are kind of going nuts, maybe there's less distribution, maybe there's no distributions for a couple of quarters, right? So you get comfortable with the whole process of this before you lever up and you start to, I shouldn't say lever up from a leverage standpoint, but just increase the amount of capital that you're putting towards private offerings.
That's a great point. That comes down to dollar cost averaging. If you would have stuck all your money in early 2022, you're probably in a lot of deals that are not making distributions now. But consistently, and that's what we're doing. We're just consistently staying in the market, looking for the best available deal every month or quarter. And now that the rates have made their move, buying deals today that have positive cash flow, lower fixed rate leverage, it's a great time to be acquiring. And if rates do drop, as there's some expectation later this year. And the fact is, the 5 and the 10 year, have dropped. They've moved back up a little bit, but when Silicon Valley Bank failed, the 5 and the 10 year dropped significantly, and that's really what the long term fixed rate debt is based off of. So even if the Fed hikes rates, yesterday they didn't hike the rates, but even if they were to hike the funds rate, which raises SOFR, the 5 and the 10 year don't always move as much. So the long term hold is not as affected by the short term interest rates.
Exactly. Yeah. I mean, the long-term hold isn't affected, and that's obviously, assuming as well that you have debt that makes sense. I think we're oftentimes forgetting that capital structure is so critical when you're putting a deal together, right? Not just even the debt structure, but did you buy a deal where you got some kind of a preferred equity provider that is entitled to some percentage of the distributions, or where, there's penalties if they don't receive their distributions on an annual basis, and it's basically just increasing the overall cost of capital, the overall burden on the property, right? There's all kinds of different things you got to make sure that you're structuring correctly if you're a sponsor and you're putting deals together. And an LP, I find that LPs oftentimes are just looking at projected returns, and then, sponsor market projected returns, and then they're trying to make a decision. It's like, get into it a little bit further. Ask the sponsor what kind of debt they're using. Are they using 80% leverage right now? Or are they using 65 or 70? I'd rather a deal that projects a 15 IRR with a sponsor that's using 65% leverage than one that's projecting a 17 IRR with 80% leverage, because the downside risk is so much greater in that scenario, especially if it comes with a higher rate or it comes with other terms that are less favorable. So really understanding the capital structure behind a deal, and a lot of the reserve components of it, how much you're raising in reserves, do you feel like that's enough, et cetera, et cetera. That's a really important part of this, because the number one thing you're trying to avoid as a limited partner or sponsor is putting yourself in financial distress and being forced to do something, because that's where people get in trouble. Is the deal could be performing great, but if your loan comes due at the wrong time, it could be a bad deal, right? You just want to put yourself in a position to not be forced at any point, right? So I think that there's a lot of nuance around those conversations as well. But if you're checking all those boxes, you got positive leverage and you got a long-term fixed rate, and you got, there's some roadmap to continuing to increase rents and NOI along the way, I mean, you should be fine. I think that's that's the fundamental 101, I think, of doing any real estate investing.
Very, very well said. Great. So you've got a lot of great content out there. Axel, how do people get a hold of you?
Sure. You can follow me on Instagram at multifamily wealth. If you want to learn more about investing with us or what our company does, you can go to alignedrep.com/invest. And then I host a podcast myself. It's all multifamily. It's called the Multifamily Wealth Podcast, 2 episodes a week. So whether you're an active multifamily investor, someone who's passively looking to multifamily or passively invest in multifamily, you'll probably find some value in those episodes.
Great. And we'll put all that in the show notes as well. So Axel, thanks again for coming on the show. You dropped a lot of great knowledge and really enjoyed the conversation.
Thanks, Jack. Appreciate it.
And everybody, I'd encourage you to please give us a review on iTunes, subscribe on YouTube, Spotify, or your podcast platform of choice, and we'll see you in the next episode.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at AlternativeInvestorMastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.